Mickey Dickey here. There's been some confusion on what's going on in the real estate market. And I want to give my 2 cents worth. Now, I don't want to get in the middle of these people fighting back and forth in some of these videos that are complaining about this guy fighting this guy, and this guy said this, and this guy said that, and they don't know what they're talking about. Now, a couple things. First is I am actually a certified residential appraiser, and I've been a certified residential appraiser for over 20 years. So any of these guys that sit back and tell you they know what they're talking about, let's see which one of them actually has a real estate appraiser's license and actually actively appraises homes for the last 20 years, and then we'll get their opinion on it. And until we get to that point, I really don't care what anybody else says because they're not looking at this the correct way. And they don't understand what this is about. I've been in this industry, the financial service industry. I've also done the appraisals. I've been through the real estate market. I understand how this works. And I'm just going to tell you the bottom line on this. The first thing I want everybody to understand is that the real estate market goes up and down just like any other market. Now, doesn't go follow Dogecoin. It doesn't follow all this other baloney. And it has its own cycle. And I've got one up here and I wanted to show you because it's really this simple. And I wish I could go back further and get you some better examples, but it gets too broad and you can't actually see what I'm talking about. And what I'm trying to talk about is that when people buy homes, you don't have to be an appraiser, you don't have to be a statistician or anybody to actually understand this. When people buy homes, the peak of the market is in May, June, and July. Every year, it's the same thing. And it's really not complicated as to why. Because that's when people move. They try to move when their kids are out of school. It makes things really simple. But look at the data. And again, I wish this would go back, but if you want, it would go back further. From September to January, it goes down. From here to January, it goes down. From here to January, it goes down. Every year. Now, the question is how much? And this is the average sale price. Now, the problem is that there's a lot of things that are involved in the average sale price. How many large homes were sold? How big were the homes? You might have a year where you don't have as many larger homes being sold for larger values. Again, it's not as simple as just taking the number. But my point is that from June through January, basically every year, you're going to get a reduction. Is it 1%? Is it 10%? Is it 20%? And everybody freaks out about it every year. And they were freaking out about it last year thinking it was going to be this crash. Now, in one of the videos I'm going to pull up here in a second, the guy from Clear Value is talking about this other guy and beating him up over not doing the correct analysis. And frankly, he's not doing it right either. He is correct that it is supply and demand. There's no question about it. But they all go back to the '08 crisis. And basically, nobody even understands what the heck happened in '08. And I don't want to go into too much detail, but what happened in '08 actually started in 1998. I've done other videos on this, and I'm not going to completely rehash it. But if you don't understand what went back and go back to 1998 and 1999, what happened in the whole subprime debacle and how Barney Frank and the whole finance subcommittee ended up requiring Fannie Mae and Freddie Mac to bail out the subprime industry in 98, 99, '08 would never have happened. So let's keep that in mind. But there's a couple of things that went on here. Now, what they point up in this video, and I'm going to start with this one, and I'm not going to put the video up here and go completely crazy because I don't want to get involved in the conversation these guys are having. It is not acceptable to go back here and start in '08, '09, and 2010 and try to compare today to those numbers. And there's a lot of reasons for that. Yes, things are higher. And yes, you can come back and say, hey, foreclosures in 2021 were lower than they should be because it was artificially lower. And they're higher now because of this. And again, there's a whole lot of things going on here, and I get it. Time frame here of 2020 and 2021 are, again, artificial, and even 2022 is artificial. So you have to ignore them completely. And I don't know that you can even take 2023 as being accurate. But the next part of this that is a problem is here. And he wants to talk about the subprime mortgages and all of that. Now, that's great. And he's not wrong from that aspect. The subprime mortgages, the adjustable rate mortgages were all an issue. I get it. But what they're not talking about in both of those scenarios is this one. This is the part of it I think people completely misunderstand about the subprime industry.
200% on all my loans?
What do you mean all your loans? We're talking about 2 loans on one house, right?
I have 5 houses. and a condo.
Okay. So what this means is that back in '08 and prior to, and we're going to go back to 99 and I'm going to rehash this a little bit. The subprime industry in 1990 through 1999 had grids that they used that were basically rate versus risk. So the higher the loan to value, the lower the credit FICO score, the higher the debt ratio, and they would rate each of these. And I actually have some of these grids that how they would rate it. Would have a situation where if you had somebody who had a 45 debt ratio with an 80% loan to value with an 800 credit score, they would charge them like 7%. If you had somebody with a 500 credit score at 100% loan to value and a 60% debt ratio, they charge them like 18%. Okay. Again, rate versus risk. And it didn't work. And all of the subprime companies basically have a line of credit. And all the lines of credit were maxed out. So they couldn't borrow them on them anymore. So the federal government, in their infinite wisdom, required Fannie Mae and Freddie Mac to buy all this paper up in 1999, which freed up the industry. So in the industry, they were trying to follow some rules. Whether the rules were good, bad, or indifferent isn't relevant. They didn't work. So the government bailed them out and freed up all the lines of credit because they made Fannie Mae and Freddie Mac buy loans that didn't meet Fannie and Freddie guidelines. So after 1999, then you started getting the ninja loans, the no income, no asset programs, which is the stripper one up there. And I'm using stripper and he used stripper to make an extreme case. But it really doesn't matter. I saw loans where you had kids that were 18 years old that were working at Dairy Queen and the loan application said that they made $100,000 a year and had $100,000 in their 401k. And the computer system just approved the thing because it met the system or whatever the underwriting guidelines were. They just made it up and they wrote down whatever they wanted on the applications. And again, in that particular case, where there were people that were buying 5, 6, 7, 8 homes. So when you look at these foreclosure statistics, you cannot look at them in the way that they're being presented here because it wasn't just one foreclosure. You had these people that had 5, 6, 8, 10 homes that all of them went into foreclosure at the same time. What you have to look at in this scenario is the supply and demand curves. During that time frame, in the years leading up to 07 and 08, we had people buying homes who shouldn't be buying homes. They didn't have the credit. They were not credit worthy. They should have been renting or they should never be homeowners ever. And what ends up happening in these real estate markets, and again, this is from the appraiser side of it, what I start seeing is homes that are not upgraded. They are not fixed up or I'll give you an example. Typically speaking, in a real estate market, you will have a market where there are foreclosures. And then you will have homes that are distressed, or you'll have a home that was built in, say, 1970 and nobody's done anything to it. Realistically, there's a range for those homes. And that range might be, let's say, a 1,500 square foot ranch house. The range might be 100,000 to 120. But for the most part, nobody cares whether the home is livable because it hasn't been updated since 1970, or it's in foreclosure because whoever's going to buy it's going to completely gut it anyway. So even if it's livable, it doesn't really matter. It needs updates. It needs upgrades. There are issues with the home, or there will become issues with the home. So in the 07, 08, and the years leading up to that, you had people who shouldn't be buying homes, not in the 120 and 100 to 120 range, but they were paying 140, 150,000 for homes that people that actually know what they're doing would not pay for those homes. So they were overpaying for the home. And that's what we're seeing now in the market. So yes, it is a supply and demand thing, but we're also having people paying too much for the house. And when I start seeing in individual markets where that same house, let's say it's a 1,500 square foot home built in the 70s and a fixed up one, and completely fixed up. They put a new roof, they put in new windows, they put in new siding, they've put in new flooring, they've done everything, light fixtures, granite countertops, everything's redone, and it's selling for $160,000. No one is going to buy that or should be buying that for $120,000 or $130,000 because by the time you buy it and fix it up to make it look like the other homes, you're way overvalued. But that's not what's happening right now. You have people who don't have a choice and are buying these homes anyway. So what's going to happen down the road is at some point, the real estate market doesn't necessarily have to correct And if you watch the rest of that video, the clear value guy talks about the fact that homes don't have to go down in value, just not going to come down 30%. He's correct on that, but it will come down some because there will be some supply and demand changes over time. And what's going to happen here, and that they're all missing, is that we have a convergence of problems, starting with the student loan issue. And yes, the student loan issue is not going to affect people making $100,000, $200,000 a year, but that's a smaller percentage of the population. It's going to affect the meat of the industry. So what it's going to continue to do is it's going to put strain on the people who own homes and whether they can buy a home, or are they going to get foreclosed on? Because what's going to happen is they're going to look at the house they just bought 2 years ago. And maybe it hasn't gone down in value, but it hasn't gone up. And maybe it has gone down a little bit, but they're going to look at it and go, you know what? I don't want to keep paying the payment on this anymore, or I can't afford making a payment on this anymore. And even though we may not have the numbers going at us, it's going to affect their ability to pay going forward. Now, going back a little bit, the supply and demand curve. What happened back in prior to 06, 07, 08, you had builders building homes to meet a demand that really wasn't there. You had a bunch of people who should have been renting. You had a bunch of people who should never have owned homes, who didn't qualify buying homes. So the sales were off the charts, the number of sales. So the builders kept building far too many. So what you really had here was an overabundance of new construction homes that took years to build, to burn through, because you only really have so much demand. And I'm going to use a specific market. In a specific market, you might have 1,000 people who are trying to buy an existing home, and there's 1,000 people who are trying to buy a new home. Because the market was so screwed up because of what we did, the market looked like we needed to be building 2,000 homes, new homes a month. So the builders started building 2,000 homes. And it takes time. They have to buy the land. They have to improve the land. They have to get water to it, electric to it. All the development, it takes 18 to 24 months to start a development. So you had all of this construction going on, a new construction, which was messing up with the numbers. So they thought they were building for 2,000 homes when they only needed to build was 1,000. So we had way too much supply. And that's where all these foreclosures came in, which again, they were selling them to people that really didn't qualify. And if you want to question those numbers, I can actually give me a call. I'll sit down with you and I can walk you through where it actually happened. We actually had developments here in the Carolinas where literally no one owned, even though every mortgage that was done was written down as that was their main house, that they were going to live in it. And we had 10 people, same person buying 10 homes in a development, and a development might have had 70 homes in it. And you had 5 people buy 50 of the homes. And they were just renting them out, hoping that the homes would come up in value and they could sell them out down the road. But they were all financed as they were their main houses. So again, these numbers are not just skewed, they're really skewed to the wrong way. Now, what they're telling us now is that the builders are not overbuilding. I hope they're right. I can't find anything that's showing at the moment that we're overbuilding existing homes. So there's nothing I can actually see that's showing that the supply is going to be out of whack. But my concern is that with interest rates being high and the car payments being what they are, cars go bad. People need new cars. They're going to have to finance them, and they can't get the interest rates that they can anymore, which means their payments are going to go up on their car payments. Their payments are going up because of student loans. Their payments are going up on their credit cards. So the housing market is going to be affected by that, but it's also going to be affected by the fact that a lot of the office buildings that are a problem in New York and Chicago and some of the larger areas are now being turned into rental properties. And what I am seeing is an overbuilding of rental properties. So I think you're going to see a whole bunch of people who cannot buy homes leave the home purchase market, go into the rental market, and kind of hibernate until the real estate market turns and goes the other way. That's where you're going to see the decline in values. So naturally speaking, between now and January, you're going to see the market decline as far as the value of homes. That's just normal. There's nothing to freak out about it. You're going to see the news freak out about it, but it's nothing to freak out about. Where the problem is going to be is when we start seeing the supply change. Because right now we have too many people trying to buy too few homes. You're going to start seeing that go down. You're going to start seeing, because of the things I'm talking about with the student loans, with the car payments, with the credit cards, with these other items, there's not going to be that many people looking for homes anymore. They're going to be in the rental market, which I think you're going to see too much in the rental market, which is going to affect the real estate market, the housing market. Now, is it going to be a 38% crash? I'm not going to say that, but you will see a reduction. And the typical 10% is not a correction. It is not a major issue. I do think it's going to be a little larger than that. But the bigger issue is not, is there going to be a 10% reduction? The question is, does it stay there? And I think that's where the question's really going to be. I think you're going to see a reduction between now and January as normal. And I think you'll see a little bit of an uptick, but I don't think it's going to come back up to its peak again. I think you're going to see it come down, and no, it's not going to totally correct, but I do think you're going to see year-over-year reductions, and there are going to be separate markets where this is going to hurt worse than other areas. But nationwide, you're going to see these numbers. And I think people are going to freak out about that because they're going to be upside down in their cars. They're upside down in their student loans. They're upside down in their houses. The economy's in rough shape. They're going to start seeing unemployment go up. I see a convergence of all of this over the next year. And I think it is going to be elongated. I don't think we're going to see the snapback that we just saw here in the real estate market. And that's because of the underlying numbers. And yes, it is supply and demand. And I think the supply and demand numbers are going to change. So when you look at this stuff going forward, that's what I want you to focus on. Now, where my analysis may be incorrect is going to be all the inputs that I'm talking about. Now, I'm giving you a whole lot of variable, and there's a whole lot going on there. It might be that the student loans are not a problem, that people are already handling it and it's going to continue to move on. It doesn't affect anything. It might be that the car loan industry doesn't change. Like some of the stuff I'm seeing right now, I'm still seeing low interest rates. I'm seeing where you can get a 1% or 2%, and maybe it's not going to change that borrower's car payment. And if that's the case, and we see a very small decline in the value of the home, we might see it turn back the other way because they might be weathering this storm. But if we start seeing unemployment rolling up, and most of you heard my videos from the beginning of the year, I said that the key here is, does unemployment stay below 4%, right? Because Powell was talking 4.5, 4.6, which clearly we haven't gotten there. And we didn't see real estate completely roll over. And again, it's not going down from June to December. It's the year-over-year numbers you have to look at. So dig deeper into these numbers. Focus on what's actually important. And what's important is, what did the sale price of homes, were they in December of last year versus December of this year? Look at August of last year versus August of this year. Don't look at June of this year to December. That's not relevant. Are we up or down year over year numbers? That's the important part. So if we start seeing year over year numbers that real estate are down 1% or 2%, not a problem. At no point last year did we see real estate down 10, 15% year over year numbers. We saw them down 11% from June to January, but not year over year. The year over year numbers where we got to be focused. So focus on unemployment, focus on student loans and how that's affecting people's money and ability to pay. And again, not just pay, but that's money coming out of the GDP and what's actually being put into the market. And it's going to have a cyclical effect. If you have $300 or $400 a month coming out of everybody's pay, and it's not going to buying movie tickets, it's not buying a steak dinner, it's not buying groceries, it's being paid to the student loan, that's going to affect GDP. Again, not tomorrow, but 6 months, 9 months, 12 months from now, and it will have a deteriorating effect. If that becomes a problem, the same thing with the car payments. A bigger car payment's going to make so that they can't pay as much money on all those things, and it's going to go down. These things may not be a problem, but these are the things I see that could potentially be a problem. I do think the real estate market in and of itself is going to have to slow down. And again, I don't necessarily see a huge turn, but I completely disagree with both of these guys, and especially the gentleman that said that the market went down 11% last year. It did not. It declined from June to December 11%. That is not a year-over-year decline. It is not a decline. Focus on year-over-year numbers in all of these aspects because that's what's important and that's what's real and tangible. and what's going to go forward and what most money managers are looking at and how they're going to invest their money. Again, if we start seeing those things tick up, it's going to be a problem. If we don't see them tick up, then the soft landing's still on the table. So again, this is from somebody who's actually been through this. This is from somebody who's actually doing the analysis and looking at the numbers. This is what's going to happen. Now, we don't know what's going to happen because you can't predict it. If we don't know how student loans are going to be affected, we don't know how car loans are going to get affected, we don't know how higher mortgage rates are going to affect everything. We might be perfectly fine, but we may not. So that's what you have to focus on to know what's going to happen. You just have to watch the incremental numbers. And if you watch them, you'll see them either gradually go up, tailor off, or go down. And until we see the trends, we're not going to know. So there's no point in sitting back here and going, I think this is going to happen. We know this stuff is happening. The question is, what does it ultimately affect? And we don't know the answer to that yet, and we can't know it. So follow what's going on. Make sure your portfolio is set up for your long-term goals and objectives. Talk to your financial advisor. Dickey out.